that's also quite daunting as an investor to be able to put money into something that is perfect for now, but it last, 3 to 5 years? Will it even last 3 to 6 months? I don't know.
Hello and welcome to another episode of the BetaKit Podcast. I am Douglas Saltis, editor-in-chief of BetaKit. And did you know that Swedish vibe coding startup Lovable recently announced that it had grown from $1 million to $100 million in ARR in just 8 months? Those numbers are insane, but they're not outliers. New data from Andreessen Horowitz shows that the median enterprise company now reaches $2 million in ARR in its first year alone. That means best-in-class performance from the pre-AI era of startups would now put them on the low end of today's benchmarks. What the hell is going on? And how can a startup count annual recurring revenue if it has only existed for a few short months? Joining this week to help me understand how AI is changing startup math is Ripple Ventures managing partner and fellow podcaster, Matt Cohen. So grab your calculator and let's dig in. Are you looking to amplify your organization's impact? Join the BetaKit Innovation Leaders Program, designed for incubators, accelerators, and innovation orgs of all sizes across Canada. Members receive brand visibility on BetaKit, access to exclusive events, and promotional support to spotlight your initiatives. Your founders get to attend monthly media training and weekly office hours with people like me. To learn more about how you can support your community and scale your organization's story, head to betakit.com/innovation-leaders and join the Innovation Leaders Network today. All right, Matt, I really appreciate you joining me for this conversation. I think maybe before we get in, do you want to say just a little bit about your podcast for fellow Canadian tech and venture enthusiasts who might be looking for, a number 2 backup listen when they're not consuming the BetaKit podcast?
Hi, everyone. I'm Matt Cohen, founder and managing partner of Ripple Ventures. We're an early stage venture fund in Canada, based in Toronto and British Columbia and Vancouver. I guess I'm also a fellow podcaster by night and day. Record a show called Tank Talks that we drop new episodes every week, mostly focusing on business, politics, startups, and operators turning their, everyday passions into overnight successes. It really started as a way to keep myself sane during COVID, as a lot of people were just sitting at home bored. And now it's turned into over 260 plus episodes. We record sometimes a weekly news rundown with my co-host, John Ruffalo from Maverick Private Equity, a well-known figure in the Canadian startup scene. And we also get to meet with some pretty exciting guests and hear about their stories and also cover a lot of the stuff happening in AI around the world.
That's awesome, man. 260 episodes is nothing to sneeze at. For every podcast that was launched, or in the case of this podcast, relaunched during COVID, that's like a huge accomplishment.
Thank you. Thank you.
But you are not a podcast host on this episode, sir. You are a podcast guest. So we are going to be hitting you with doozy questions. And I think where I'll start is, what the hell is going on? Having covered this space for like 20 years, having been in it, I think, at least for the last 10 or 15, there's been a pretty standard state of affairs when it comes to, let's say, software as a services companies. And we'll use that super, super broadly for the sake of this conversation. AI startups in the last, 12 to 18 months seem to be grabbing revenue faster than ever before. Is that your experience? And what can you point to the reasons for that happening?
Oh, absolutely. It's our experience. But I think there's like 2 different worlds that we're living in right now. There's like AI first companies that are absolutely grabbing the headlines, who are totally centered around like the food chain of AI. And then there's like the AI empowered, or the AI like kind of offered as a sidebar solution, in their product offering. The thing that we always laugh about, our first fund was a 2019 fund. And if our 2019 companies were able to start in 2023, call it, they would have been lights out. is what we and the founders always joke about, because they've had to completely rebuild their entire tech stack from 2019 to 2023. It was useless, garbage, compared to what companies who are now able to start in 2024, 2025, building from scratch are able to build with every single API integration, third-party tool off the shelf that they don't have to build internally, is just totally different. And I remember even like, our first company back in 2012, the early days of like machine learning and indexing, and all the different ways, and we were doing recommendations, for customers inside of our applications, is just non-existent anymore. You don't even need a tech team to do that. So the bodies that you threw at the problems is different. The ways in which you get a product into the hands of customers and, beta users, design partners, whatever you want to call them, is way different. And so it's almost unfair to look and compare a company that had started building in 2018, 2019 to someone who started building in 2025. It's just night and day. So there's a lot of baggage that has come with a lot of these companies that have had to restart their business with an AI first approach. But it's not all just sort of bad news for those companies. They do have one big advantage for them. And the biggest advantage is they've gone through the shitty part of building a company with the wrong tech stack. They've probably burnt money they wish they didn't have burnt, so they've got some battle scars from that. And they've also been able to hone in on the problem that they're solving much better because of all the failed pilots and, lack of conversions they've had in their renewal cycles, to know where to point the gun when they go out with their next product launch.
Okay. This is really interesting because I started at the kind of the output end of revenue, and you went back to the core structural considerations of building the company that's influencing this. And I think what I'm hearing from you is, if I that 15-year SaaS era that I'm talking about was this age in which, prior to that, oh man, you could have this great idea, and then you had to raise money because the hard cost of purchasing server racks to scale your business was really difficult. And then the cloud era hit, everything was virtualized in that way. And like literally two people in a coffee shop could start a company. Now, scaling that company to that 1 million ARR point was still arduous in terms of front end work, back end work, finding product market fit, all that good stuff. What I'm hearing from you saying is, the ease of the launch is still there, but there are so many more barriers to development, shipping, maybe the amount of staff that you need, the amount of revenue that you need, that AI is enabling with these companies, so that even if they're not, let's say, an AI first company, if they're not a large language model company, they're not a foundational AI company, it's not just, hey, two laptops in a coffee shop, you can start a company. It's like two laptops and like a Copilot instance, and you can scale a company. Am I getting what you're saying right? Do
I
you want to
think,
parse some of those?
yeah, I don't want to say it's all just exactly as that, because there's different kinds of companies that are getting created nowadays that I think we as venture investors need to be aware of and totally open and transparent about, which is there are people that are going to be building these scaling fast, like $0 to $1 million ARR businesses, in their dorm room or in their garage per se, but they're going to cap out very quickly, right? And they're not going to go down the path of venture scalable, 100 million of ARR. Those companies are still going to require human beings, marketing, sales, executive teams, things like that to get to that level. And so not all companies that are in the AI realm are going to have the same amount of success, but there are going to be a lot of lifestyle businesses that get created in this time period. And I think a lot of founders are maybe confusing themselves, in terms of what they are and who they are trying to become when they're building these companies. Some may say, I've gotten from 0 to 500K in ARR with zero funding, and I've got this amazing AI agent that so many people are using in like the prosumer space. Okay, that's great. Have you gone through renewal cycles? Have you been able to actually speak with any of these customers, or are they just signing up with their credit cards to know what they want for the next product launch? There's a lot of things that need to be done to get to the next level, call it 5 or 10 million plus of ARR. And I think those companies there's going to be a lot of them. There's going to be a lot of zombies. And let's be honest, like some of them can get wiped out tomorrow on the next, OpenAI Dev Day launch. They absolutely could. And we're hearing stories of that, in our own portfolio of companies that we've had that have been building some amazing technology. They're worried that there could be something that replaces them from an Amazon, from a Facebook, from, whatever. And that's also quite daunting as an investor to be able to put money into something that is perfect for now, but will it last, 3 to 5 years? Will it even last 3 to 6 months? I don't know.
I want to even just go back to something that I think you're touching upon, the difference between the different types of companies we're seeing making these claims, because I led with Lovable, 1 to $100 million in
120 million in
God
7 months.
damn. In the newsletter where I was talking about this, I also linked out a Ripple portfolio company, Clover Labs. They've gone from 0 to 1 million in 42 days, which is like also a rapid acceleration. Can we set maybe a difference between, say, the Lovables in the world and maybe is Clover Labs a little bit closer to that lifestyle, or in that earlier stage of not knowing? And I don't mean to call them out, but just
No, for
knowing
sure.
where Ripple invests, if you could help us triangulate the difference between some of these companies that are at that higher tier stage, that are going at the speed of like, Anthropic or whatever, and then that other tier that are using these tools, building faster, and just getting to that, what used to be, again, going back to the Andreessen Horowitz data, like if you were hitting $1 million in ARR in your first year, you were in great shape as a high scaling startup. And now it's double that. And if you're only doing one, you're at the bottom of, one of the top VC firms in the world's benchmark for performance.
I think also, I just want to clarify, like a lot of people get pretty excited when they see these overnight successes like a Lovable that was only started in September of 2024 or something by Anton and Fabian. Like these guys were working on tools like this and projects like this for several years that almost failed. Same thing with Bolt, AnySphere, same sort of thing. These things are not overnight successes. These people were hacking away on really big problems. They just found lightning in a bottle at this one moment in time. And that's when people think the shotgun goes off. And so that's something I just want to be totally transparent about. In terms of Clover, so the background with Clover is the founder, Matt Espinoza, was actually a RippleX fellow. So for people who don't know, we've run this program for the last 6 years. It's called the RippleX Fellowship Program. It's evolved since its early days. My partner, Dominic Lau, started it, when he joined me as an analyst in 2019. And really it was a way to help these young, budding entrepreneurs, builders, wannabes learn the craft of building technology and companies from the very beginning of their days in universities. And so Matt was one of these bright young fellows who had a couple successes early on during the program, sold his first 2 companies. So he set up a holding company. So Clover Labs is actually a holding company that we own a part of, and we invested in, and that has a couple of these, I don't want to call them lifestyle businesses, but one of these like fast moving AI first tools. And the one that they have that's really taken off is Red Rover, which is basically a way to manage your Reddit channels, your Reddit community, your posting on other different forms to basically get in touch with your potential ICP or customer base. Mm-hmm. This is a huge market. Reddit is the number one driver of searches and data feeds for like ChatGPT. So it is a much growing. Everyone just look at the stock. You'll see how much they're benefiting from this. And so they saw a huge potential for them to build this AI first approach to helping manage these, AI or Reddit communities and these Reddit channels. And so that's where they started seeing huge amounts of people were like basically saying, hey, where can I sign up and how can I pay you thousands of dollars per month to use this thing? So that's what happened is they just had this huge unlock. They did a bunch of like free sort of usage in the beginning. And then when they turned on paid, they just had a wall of people signing up to get them to that 1 million. But, you called me and said, hey, what is this? I said, let's not all just get super excited of 1 million ARR. Of course, it is 1 million of ARR if all those customers continue to pay on the month. But I think what your, opening remarks kind of is going to lead us to is what is ARR today, right? Do you want to set the stage for that?
Yeah, let's talk about it right now, because for me, again, part of my interest in this topic came from, I'm always trying to track the deltas of technology ages, having been around for a couple. understanding which rules stay the same, which change. I think part of the value that BetaKit can provide is, you know, reminding people of what has happened before so that they can truly understand what's new and novel. And for me, the two things that stand out are I haven't seen revenue generated at this speed before, not for software. And that's from the 0 to 1 million or the 1 to 100 million, or, even up to the foundation, like what OpenAI and Anthropic or even Canada's own Cohere are doing is like pretty hefty, right? Compare that to like a Shopify a decade ago, and it's not even close. Now there are caveats to that, which we'll get into. The other thing that I'm noticing is that you have within these timeframes, these companies claiming ARR, and they're not referring to annual recurring revenue, which is like the most stalwart SaaS metric there could be. They are referring to the annualized run rate. Basically, if you take a snapshot of their revenue within that month or that quarter and multiply it by 4 or multiply it by 12, they're getting a number that looks very, very interesting, very, very sexy. I reached out to you to ask about this, as well as Radical Ventures, Sanjana Basu, to try and triangulate, because, where you're at, early stage, Radical a little bit later stage, what's going on here? Is this definition of term usage change a reflection of a bunch of new startups coming up and tracking their growth a different way? Is it reflective of the fact that these things are happening so fast, so they're going to look at an annualized number instead? Or maybe to what you were alluding to before, is there a little bit of like promotional snake oil in dropping a Twitter or X thread saying the game has changed? We if you take this day's revenue and annualize it out over 365 days, we're stinking rich. Like, how do you see this? Because you go online every day and there's another company using what used to be a pretty definable metric to indicate rapid growth.
Look, I don't think, Doug, you and I have seen what it looks like when you see like $1 million a month in MRR doubling, you're quadrupling every month over month. And when you see it the first time, you become pretty desensitized, I guess, the second time and the third time it happens, right? So I think until you see it, you don't believe it, and that's totally fair. But it's happening, and we are seeing it. I mean, just go look at Henry Shee's Lean AI leaderboard. So first off, nobody regulates what ARR is actually supposed to mean: annualized recurring revenue or annual recurring revenue, right? So let's be fair. It is probably an MRR times 12 metric that most people that we see are quoting. Now, as investors, institutional investors, we get to the crux of that pretty quickly. It's pretty simple. Show us your contracts, show us your billings, show us your churn, show us your renewals, and we'll get to the bottom of like what a normalized ARR. But for us, we don't care because we're not investing at the revenue stages. For the radicals of the world, it does make a difference. But if they're trying to do kingmaking and try to bet on the top 1 or 2 leaders in a market, also doesn't necessarily matters. But just go look at like the Lean AI leaderboard from Henry Shee at Super. You've got, Surge AI, which is in like the labeling space, like a scale AI, billion plus of ARR, 110 employees, started in 2020, 9 million plus revenue per head. So that's where the numbers start to make sense, is where people are like, what is the revenue per employee? People love that metric. So a couple things is like revenue per head, net revenue retention, gross revenue retention. You go down the list. So Lovable, 75 million now. I don't know when this was taken, but it's probably like 120 is what they said now. That's probably on the last month or two that they're annualizing that number out, right? You've got so many of these companies that are doing this, but as long as it keeps growing, which it seems like it is, and the growth, that's what the net revenue retention is doing, is outpacing the churn, then you've got yourself a flyer. And that's what people are basically betting on now, is that the growth will just outpace the churn. And whatever you see at the end of the year is going to be bigger than what they started the year at.
Yeah, I think that's a fair point. I want to note, when I'm calling out the shift in term usage or how it's calculated, that's acknowledging that in the same way that people used to actually refer to a seed round, an A round, a B round, a C round, a D round. It used to actually just be ordered in terms of which way those rounds come. And now it's completely conflated and tied up into like, we're doing our pre-A, we're doing our
Yes,
A1,
exactly.
there's a component of marketing there here. I'm not saying, this isn't like, is it truly champagne? Because if it's not from the Champagne region, it doesn't count. But I think there is a bit of, in these messages, a lack of clarity when they're referring to an annual recurring or an annualized. On the other side, completely take it. If the annualized number keeps going up, that is a sign of traction and growth that is significant and meaningful. At the time of this recording, we recently covered Cohere as a new $500 million, co-led from a couple of Canadian venture firms. I believe Radical and Innovia, as well as some Canadian pension funds. And in that, we were able to confirm some reporting that's been going around that shows that Cohere's revenue has jumped from 100 million in annualized to 200 million in annualized. Now, whether or not that continues remains to be seen. But if they keep marking 12 months out based upon what they're doing, and that number isn't doubling, that's really, really significant. I want to get into some of the evaluation criteria that you just laid out here, though. But before we do that, I think it's really important to track the difference and dig in a little bit to what you were saying, like how Ripple might evaluate this versus later stage. When we were talking in the run up to, I guess, this episode, but then also the newsletter that I drafted, you had said something really, really interested. Like some of these like evaluations are a little bit beyond the stage that you invest in, and you said we invest in people and problems. And I wondered if you could just expand upon that a little bit, and also maybe in that explain why some of these later stage numbers and evaluations are a little bit beyond your scope. Because it's interesting to hear if you say be like it's cool to hear people and problems is your like focus, but then it's also like how much do the numbers matter to a VC at certain stages? I think is a really interesting conversation to have.
Sure. Yeah. So at Ripple, we're a pre-seed fund. That means we'll write checks as low as 50K all the way up to $1 million US. And, pre-seed is a relatively new word for some people, but it's been around since 2017 or so. And it was really a space where like it was too early for seed and it was like too big for, friends and family. And it was a way to kind of back people who just had an idea and a pitch deck. And in Canada, there hasn't really been an institutional pre-seed fund. A lot of the people who are building ideas and companies out of Canada, they often used to go to like the angel community and then maybe to a YC or to Techstars. And when we started in 2018, 2019, we saw that there was these really young, smart builders who were coming forward with an idea, but really what they were coming forward with was a solution for a problem. And what our job was is to validate the problem and then figure out if they were the right people to build the solution, because it most likely wasn't built when we started investing in them. And so over time, we've seen 10,000 companies a year. What we realize is that the problem is the most important thing. What does the problem mean? It's like, what's the size of the market? Who are the ICP customers that are feeling this? Can we go talk to them? Can we validate this problem is real? How urgent of a problem is it for these potential customers? And what is their willingness to leave the current solutions they're working with to maybe try something new? And the reason why we focused on it that way was because the idea that a lot of people start out a company with is most often not the idea or the solution they end up delivering on when they end up having success, if they have success. And the problem we also found is that people gave up too early when they realized the problem wasn't as big or wasn't as urgent as they thought it was when they pitched us originally. So we said, wait, let's back up for a second and let's not take the founder's word for what they think the actual problem is and what the solution they've already started building on that they're now trying to raise money on is basically what we should be investing in. Let's go find the best people and let's go see the problems that they tell us are real and validate them themselves, and then see if the two of those make sense for us to be backing them. Because what we thought was if the people are as good as they say they are and they're technical enough to build it, meaning they're not outsourcing anything, they don't need to hire a big team to build the first like MVP or prototype, and we can validate the problem is urgent enough for them to build something and sell into, then we've got ourselves a pre-seed bet. And that's how we kind of analyzed it. And that's what we do here. Make sense?
Yeah, I think so. It's like, do we believe in these people? And then do we believe in the target that they're aiming for, knowing that that might not be the final destination, but where they're starting, right?
The Figma example is like the one we always kind of study and learn, where Figma was like, Dylan had this vision for what he wanted Figma to be as this collaboration design tool. It took him 4 years though to turn on the revenue because he was so obsessed with the problem and the product and the people around it. And so I think like for us, we want to make sure that we don't have to wait 4 years for someone to say this is a validated problem, but we want to know that people can keep building into the right wedge into a potential customer base and then expand from there. And we've seen that where we've like called customers, potential customers, and said, hey, if this problem, were to be solved like this, would you be happier than what you're currently dealing with on like Microsoft Office or something? And if the answers are a resounding yes, it's like, okay, let's give this team like 6 to 12 months to try to build an MVP solution to get in the doors with these customers. And we'll land a $5,000, $10,000 pilot, and then we'll ramp from there.
That is very, very different than the evaluation that Radical would have to make or an Innovia. But I think you can maybe speak to the other side of that because, at the end of the day, you're making that pre-seed investment and then seed through later stage. You're probably helping these founders
100%
through that process, and you're probably looking to take a little bit of money off the table or fight to stay in those deals depending upon the company. So like you're in and around these conversations. So I want to note, speaking with Sanjana and you as well, you noted kind of it's the retention benchmarks that companies are looking at, that net revenue retention, which is kind of like how that MRR, the monthly recurring revenue, is expanding, how much it's churning. Chris Arsenault sent me a message, Innovia's Chris Arsenault, being like, Douglas, you've got to talk more about churn. Sanjana also mentioned that she at Radical is doing a different customer analysis than maybe the one that you were speaking to. You seem to be going to talk to customers to see if there's a problem. She's talking to customers to see, is this product sticky? Are they going to stick around? Things like that. Can we switch to that other side now? And once a trajectory has been set, team has been believed in, talk a little bit about the math of that evaluation. Is it just making sure that the customers that these high scaling companies have found are sticking around? Like, what are the unit economics of this?
Yeah, and just to set the context of like why we can talk about this as a pre-seed investor, like we are the first institutional check into our companies. We typically run all of our fundraising processes for all of our companies, from the seed to the Series A and beyond. We have companies at Series C as well. So we've seen all the sort of like the pitch decks, the pitches, the stories, and the numbers that go into it. I'm on the board of a Series C company, so like we see all this. So this is what I would say. For sure, everyone is going out with a great story that they've got hopefully great growth metrics and good customer, expansion and great pipeline. There's a couple of things though that investors obviously know. Everything's going to look great on the surface when you go out to pitch, but when the rubber meets the road is like when they start doing their due diligence, it's yes, they're going to take some customer references, but they're probably going to do their own customer references as well. They're not just going to take the best ones. And the questions they're going to ask them are as follows. 1, how did you find this solution? 2, what were you working on before this solution? 3, what's the ROI that you've gotten from this in terms of either money made or dollars saved? And 3, what's the size of your wallet? Or 4, what's the size of your wallet you have for this? How much more can you spend for this solution than you're currently spending? It's hard to get that information out all the time, but that's pretty much it. And then the investors are going to say, okay, well, they're good. They're doing $5 million in revenue this year. They've grown 2x or 2.5x from last year. They've got a huge pipeline of big brand name logos that they're trying to convert, but the sales cycle is 6 to 12 months. And they probably are going to close maybe 20% of those. Okay, let's put a forward multiple of whatever X, 20, 30, 50X, who knows? But then you got the market, and the market can just be competitive. Someone can come in with a 50 or 100X multiple on their, put forward earnings and blow you out of the water. And whatever research you did doesn't matter, because everyone would have said, hey, Airbnb or Coinbase or whatever, pick your IPO of the last, few years and look back on their Series A, Series B rounds and see how expensive they were compared to the rest of the market. And you would have thought those were insane. But in the game of venture, if you're trying to basically pick the top 1% outlier in a given market, it doesn't really matter. The market sets the price. And so no matter how much due diligence you do, no matter how many customer calls you do, if another investor wants that asset more than you, too bad. That's how it works. And so you can grovel as much as you want and say, like, there is some math that goes into these types of like due diligence processes. But in the times that we're living in now and how much market there is available with AI to grab from traditional SaaS businesses or just traditional businesses in general, it's freaking massive. And so if you really think that a company can go from like 10 to 100 million in like 3 years, you're going to pay whatever you want.
You're talking about some real mathematical diligence and triangulation that comes with these companies actually engaging with their customers, which can be helpful. And then you're also saying at the same time, there is still this have and have nots environment where if the froth in the AI space is there, you're fighting just term sheets that have maybe not an expectation of return, but an expectation of maybe winning the deal at that point. How much of this is being driven by just the knowledge that there are Andreessen Horowitz's in later stage, or like the craziest thing we've been seeing in the AI space at the upper levels is the amount of CapEx that Microsoft, Amazon, Google are spending to play in this space. Does any of this evaluation hold to math as long as there is another tier level of investors that are willing to get into these deals?
So if I understand your question correctly, it's like, okay, let's look at the source of like input into the entire AI economy and then see how it like trickles down into where money can be made along the way.
Yeah. And the easiest comparison that we have actually happened in the COVID era in Canada, when we saw at the end of 2020 into 2021, this huge influx of capital from the United States. You had the Tiger Globals coming in, doing one-page term sheets with no diligence. And all of a sudden there was this huge explosion of money that was, flowing over the brim of the US and landing into Canada. And it was completely changing the amount of revenue that was it was completely changing the amount of capital that was being raised in Canada and those terms. It seems like a similar thing is happening in the AI space from all sides, not just from the Tiger Globals, but from like the FANG companies.
One thing people always love to kind of like look back in history and say it's repeating itself in terms of like the .coms and how like there were basically dark fiber that was being laid in the hopes that the internet would be this huge, gigantic thing where all this demand would come. It's not the same this time around because the demand is already there for a lot of this stuff. And the CapEx that's being spent right now, I think it's 370 billion or something just alone this year between all the big mega hyperscalers. I mean, it's showing up in the GDP numbers, for God's sakes. It's massive. And so the thing is that the CapEx that's being spent, is it trickling down to like traditional startups? Probably in different ways, but it's not really the thing that matters. The question is that one, is it sustainable? Because the demand is there for any of these solutions. And yes, the best ones are going to hopefully capture more of it. But is the moat strong enough for it to withstand the ability to stick around for more than a couple of years? Or is a commoditized free solution going to replace it within a year or two? I mean, that's really the biggest threat to all of these software companies that are being funded. And so I don't like to say it's like a Ponzi scheme in terms of like, get out, get in first, get out before the last one's out. But it feels sometimes that like nothing is invincible in this market because everything is becoming commoditized. Everyone is betting on each other. Like all the top tier one VCs are cross betting across like the legal AI space and the healthcare AI space and all of these, vibe coding tools. There's VCs invested across all of them. So what I would say is like what we're telling our companies is that build relationships with your customers that can withstand their unwillingness to switch to another provider. Like that is super important that you know their pain points, their problems, their inner workings of how they're judged and who their bosses are to say it's going to be too much for me to switch to another solution, which you won't always protect yourself against, to know that your recurring revenue is sustainable. Because I mean, at the end of the day, if you're not selling on a secondary and you're not going to go IPO, you're going to probably sell to private equity. And by God, they're going to eat up your entire CRM and all of your numbers are going to get crunched down to some finite number that you're going to have to justify if you want to get a transaction done and sell this business to them.
So I just want to go back and say, I'm not saying that this is a Ponzi scheme. I'm just trying to clock the unprecedented level of liquidity and interest from all stages. Again, Innovia in their state of software report for 2024 identified this as like a tale of two cities where like there are certain conditions for non-AI or non-AI enabled companies, like the traditional evaluation, and then there's a whole different set of evaluation criteria and interest for AI companies. Even when you just have, a company like OpenAI saying, we're going to need to start spending trillions of dollars on data centers. It's just like a whole different environment that we need to clock. But I want to turn to, like you mentioned, this defensibility of the competition component. I think we should dig into that a little bit more. I also want to go back to the ROI consideration because that's something where it's like whether or not this continues, unprecedented amounts being spent, will there be a return? I know in Canada, we've yet to see the productivity returns that have been hoped for coming from AI adoption. Cohere's co-founders have been very, very vocal about ROI with their enterprise focused customers being a big point of contention and like all of these different trials that they're running, like needing to get past the trial phase into like actual like lock-in with customers. Um, there is also this component where companies like Cursor that are also experiencing exploding growth, they are kind of on that tip of the spear vibe coding circumstance, but they're built off of Anthropic's models. And they are in a position where they are spending tons of money that is being passed through to Anthropic to power their service. And Anthropic is essentially using that money to promote their competing tool, which I think goes to what you were saying in terms of like, is there a moat? Is there defensibility? Can you count on this stuff being here anytime soon? Are you seeing indications that, let's say beyond the coding space, but broadly across the industry, that the ROI is being demonstrated for those next evaluations, or is it still anticipated?
Well, it's funny you bring up like the Cursor example as one that's like the biggest ROI because yeah, it's the biggest ROI to like startups who don't have a lot of capital to spend on hiring developers and they can do 10 times as much. We're seeing the ROI there for sure, but like that's almost like the Uber model where it's totally being subsidized, right? Nvidia is the one who's making all the money off of this at the end of the day. The Anthropics are subsidizing it, the Cursors are subsidizing it for the $20 a month or $200, whatever it is. They're subsidizing it. If you look at the margins, I'm sure they're not SaaS margins. I guarantee they're not SaaS margins, but it's a land grab. And so, but now you've got Cursor, obviously, with the Windsurf news that happened, and then you've got ChatGPT 5 or GPT-5 that came out, where they're now incorporating that, trying to get off, the Anthropic only models, the cogen models. There's obviously this risk that they wonder, like, okay, like will Anthropic, bite off their nose to spite their face in a way to sustain themselves against what obviously ChatGPT and OpenAI are doing. Who knows? Like who can bet on that as an investor? I don't want to ever step into that lion's den. And hopefully I'll be out long before it even gets to that, steel cage death match. But
can we just pause on that? Can I ask you, is that because of, where you play in this space, you have experience and have really indexed on those earlier bets? Or is that just
yeah,
a reflection a little bit of like the speed of how fast these things are moving, where it truly, like anyone who tells you they know where this stuff is going,
look,
unless they are an NVIDIA executive, is making it up because things are happening so fast?
This is where it comes back to people and problems. I remember when the ChatGPT dropped, and there were a couple of companies that I won't mention that called basically me that week and said, "Holy shit, this is the end of us. Like, we are done. There's no way we can survive this. It's going to basically make us non-existent for at least we've got 12 months to figure this out." Luckily, they had runway, and there's a lot of those like walking zombie corns out of there. But what they did was they were great technical builders, and they were great problem thinkers, and they were able to pivot into a much better space that nobody, was going to compete with them on. And they're doing very well now and growing like 250, 300% year over year. I can't say that for every company though in our portfolio. Like, there's definitely some that move too slowly, kind of like when COVID happened, they moved too slowly. They kind of saw the writing on the wall, but they didn't move enough to change the course and pivot completely to get away from that. And I think we're still going to see that happen more and more often. But for us, this is why we invest in people and problems, because if you can invest in great people who can pivot quickly, they're going to find a way to find something better to solve. And if the problem is deep enough and strong enough and they've studied it more, then they'll find a new angle to get themselves into a solution that's more accurate onto the pain points that customers are telling them about. So that's what we care about. But I think, like there's companies right now that have had to completely, cut bait on something they've spent 3 years building and a lot of millions of dollars building into, that they're now having to scratch and restart completely on an AI first approach with half the headcount and a pretty old school industry. But I'll tell you, like within the first 2 months of launch, they've already outpaced the ARR they had from their legacy business.
Yeah. Okay. Let's get into this a little bit, because you touched upon this up top when you were talking about established companies having an advantage because they have a little bit of battle scars, even though they are now having to, man, if they could start fresh, they'd be doing things differently. And they're kind of being forced to. There's been a lot of reporting in Canadian tech specifically, but also I think broadly across North America, of companies going AI first. Toby Lukey's memo has been regularly referenced. You've seen everything from scaling startups like Clue, which we've written about, really lean into reducing staff and pivoting in approach, to publicly traded companies like OpenText, which I think maybe dragging on the chemtrails of Shopify a little bit, made a similar AI first announcement and some reduction in forces. That led to the CEO of OpenText being replaced, maybe because that decision wasn't made fast enough or happening fast enough. Is what you're really referencing here going back to that idea of, man, if only we'd have been able to start our company in this environment, it would be radically different in structure? Or does it go back to that idea, you mentioned this metric of revenue generated per employee suddenly raising to prominence because there isn't this expectation that as you scale, you're necessarily adding more people?
Well, I think Toby said it perfectly. It's like, if you can justify that the job that you want to hire for as a manager cannot be done with the AI, then we will award you the resources to go do it. But if you can't, and we do believe it can be done with an AI agent or some type of AI application, then we're not going to award you those resources. And when you have that kind of growth that they just put out in their last quarter, with, I think they've reduced their headcount from peak 11,700 down to 8,000 something, from COVID down to now, and still putting up these crazy numbers. How could you say otherwise as a founder, right? If you, Elon Musk and what they've done at Twitter, X, since reducing headcount 70%, like if those people can do it at that scale, how could you not do that at your startup of less than 100 people? So absolutely, people are doing that. We have seen in our own portfolio companies scale down headcount, increase revenue per head. But I will say there is one but. Just because you increase revenue per head, but you're not actually making a dent in the actual growth that is required to become like a venture scale startup. Let's say you went from like 3 million to like 5 million. That's great, almost a double. And then the next year you go from 5 million to like 8 million. that's okay. That's really great growth, but like you're kind of veering off the venture path at that point. Now, if you don't require any more funding to get there, then that's good for your early investors like us. We don't really need to have companies reach 100 million of ARR to see a really meaningful return for us and our fund and our LPs. One, it's because we get in quite early at usually like the earliest stages that anyone does raise capital. And our ownership prices are pretty good. Our ownership is high and our dollars are meaningful. And two, the companies could take 5 years to get to 10 million. And when you get to that $10 million number, the aperture of buyers does open up. You get strategic buyers, you get private equity buyers, you get roll-up buyers, you get public companies that are coming in to buy you. And we've had like 6 M&A deals across, our existence as a firm. So we've seen all different types of buyers. And even with an acquisition that, could have been like a Series B price, let's say, for a company, but you buy the whole company at that price, that's a really good outcome for investors like us. But for the founders who may have thought that they were going to get to like, a $1 billion unicorn valuation and sell the company at that, you're starting to veer off that path pretty quickly if you're only going for revenue per head.
Yeah. Okay. And there's a component to this that's unspoken that I think this is the right time to address. And it's one of the most important ones if we're talking about the math changing or the playbooks changing or the calculations changing. And that's margins, right? In that traditional environment that we were talking about, a SaaS company could expect anywhere to 80 to 90% margins because again, the cost of scaling customers was relatively incremental technically, or I guess technologically. And most of those expenses were on customer cost of acquisition and marketing and growth and expanding into new markets. Once you have that land grab successfully, you turn the screws, you maximize revenue, and you then have the numbers that either keeps the market happy or again finds you that exit in the return. There's a lot of conversation right now about something called Jevons paradox, which I'm not going to try and describe in a podcast form for the benefit of our readers. But it seems like, again, in one of these distinctions between what was happening before and what was happening now, that we talked about it with Cursor, all of these being built upon whether it's someone else's models or someone else's GPUs, fundamentally, that there is not the capacity to find the margins to really capture the value of the revenue that you're generating. And there is some speculation that the way that the fundamental technologies of AI works, where the cost is based upon activity, that will not be found because the more popular or efficient the tools become, the more people are going to use them, than eliminating any of those returns. I would like to ask you if you're hearing conversations from leaders who are trying to navigate how many employees they should have, how many they should keep. I think you kind of answer that question. Are you talking to companies or hearing from founders who are like, man, the big gross revenue number keeps going up, but we are not making any more money? How much of that is a component of this?
I think margins at this time in the game are being ignored completely. And you can take the good or bad side of that decision. I actually think for companies like AnySphere, Cursor, Replit, Windsurf, Lovable, Bolt, all of these companies, they're probably sitting around neutral to negative margins, is what some of the people, out there have said. They're all private, so you can't really tell. Maybe Replit's on like the highest end of it, but they're spending a ton of money on their, dependencies on large language models. Maybe they can improve slightly with some of the optimizations that they're working on now. But I think the broader industry of AI is definitely suffering from lower margins as you start to try and gain more market share, because you got to subsidize, obviously, the growth, right? And that's not the worst thing. I mean, look at the Uber model, right? It subsidized a hell of a lot until they became cash flow positive like this year or last year. So it's not like the worst decision to make. But I think if you're going to make that bet, and we have some companies making that bet, the pie has to be big enough and the vision has to be solid enough for you to execute on for investors to keep funding you and basically subsidizing your customers. And that's why these companies have to keep raising money, is because they need more time to gather more of the market share to basically be the king of that market so that nobody else gets funded, like the SoftBank model, right? Nobody else gets funded. Eventually, the margins will start to grow as nobody else is left to compete with, and you can start to raise prices on your customers. So I don't disagree with it. We definitely have some companies that are, maybe below 50% gross margins because they have some human in the loop, because they have this huge vision of what they're doing in certain industries that are massive. But I think also investors understand that, and they know that the margins will come as long as they can continue to grow top line, 2, 3x or more every year, 5x or more. And so when you go from 10 million to 30 or 50 million the next year, who gives a shit, right? Like, you're really growing top line that much and your margins are sticking around 30, 40, 50%. I think people are going to be okay with that as long as you continue that growth path. As soon as the growth flatlines or just falls off a little bit, then people switch to margins.
That's a very razor thin wire. The other assumption there is that as long as the capital is still there to finance that, right? I guess I want to close this off by asking you where you think this goes and on what maybe time horizon the bill is due. Because even with the amount of capital just flying across the space, all of these investors, all of these funds eventually have to show returns, whether it's a 5 to 10-year time horizon, right? Even if the back end of these funds are like they're supposed to be betting on their winners that are showing growth here. When do you expect that evaluation to shift between maybe some consolidation between who the real winners are? Because right now it just seems to be all land grab all over the place all the time.
I saw a great tweet the other day. I forget who it was. It said, like, as soon as, it was the guy from Carnegie Mellon who was on the podcast with 20 VCs, saying as soon as the VC or the like VC backed startups or the big Bay Area tech companies are doing all the acquisitions in the market, it's time to get the hell out. Because if they're like the last buyer for all these companies, then it's kind of a house of cards. If they stop buying, there's no one left to buy, right? But the problem is you've got the public markets that are jumping to get access to any of these companies. So that's not slowing down, it feels like, anytime soon. You've got the big tech companies going after and spending $100 million on talent like it's freaking LeBron James of AI. And then you've got the VC market that's still pretty well funded for a lot of these companies. Now, the dry powder is drying up more. We saw the recent numbers that came out. It's dropped a lot since 2023. So I don't think it's going to end in the next like 12 to 18 months. I think we're probably got another like 2 to maybe 4 years of like this window being pretty good. The only problem is where the zombie corns end up clearing. And I think that will bring the left tail out from underneath people's feet very quickly. So a lot of these people who have been sitting on zombie corns, you know what I'm talking about, right?
Yeah,
the companies that are just the Walking Dead.
The pre-COVID companies that had been around, maybe were looking to IPO before then.
Yeah, 100 million of ARR plus, but their valuations are way too high from their last rounds in 23. They're not willing to remark them. They're doing insider bridge rounds, whatever. The pref stack's too high. They got to clear it. So either they go public and everyone gets squashed and there's ratchets and stuff, or they clear the company and they sell it for less than their pref stack and the commons get wiped and nobody makes any money really. If those all get cleaned out of funds and the LPs are like kind of back to zero, then they may want to reinvest again. And we're seeing that now, especially at the earliest stages where, the term that we are loving and people are kind of laughing at is like seed strapping, right? The pre-seed strapping or seed strapping, where companies are raising like the Stack-A-Dat model, right? The company raises a few $1 million and they just go on this tear of getting to tens of millions of revenue. Is what I think LPs are getting more excited about. But there's 2 industries happening now in venture, and LPs have to make their decision. But I don't think it's ending anytime soon, to answer your question. And I think we're living in a pretty fascinating time where the technology is being dropped, like new advancements are being dropped every single day. It's becoming cheaper and cheaper to access this technology, and more people are signing up as daily active users on all these platforms than we've ever seen before.
I don't disagree with you. I'm a little surprised by the time horizon you're laying out, but I can't find myself to disagree with you on it. Honestly, I think the most impressive thing about this is that we were able to bang out the whole state of the industry in less than an hour. It's good to have a VC on the podcast who's also a podcaster. Matt, man, I super appreciate the time, the willingness to kind of dig into the numbers, but as also you noted, the people that are kind of causing these inflections. And we're just gonna have to have you back on when this thing gets crazier or starts to implode.
Let's do it. There's always something fun to talk about every week. Why not?
Awesome, man. I super appreciate the time.
Thanks, Doug.